Welcome back. I hope everyone enjoyed lunch and this great panel we just had. It's my pleasure now to introduce Patrick Sullivan, Executive Vice President and Group Head of the Mortgage Partnership Finance Program for the Federal Home Loan Bank of Chicago. Before joining the Federal Home Loan Bank in his current role, he served as Senior Vice President and Chief Financial Officer at Wintrust Mortgage, where he oversaw financial planning and expanded his leadership across Wintrust's non-bank entities. His deep knowledge of financial markets, credit risk, and housing finance stems from his experience at Fannie Mae, Navigant Consulting, and previous positions at the Federal Home Loan Bank of Chicago. So please join me in welcoming Patrick Sullivan.
All right, thank you for that introduction. I just wanted to start by saying I spent 10 years living in Washington, D.C. It's always great to be back, and based on some weather alerts that I've gotten from here in Chicago, probably going to be extending my stay, so good thing I like being here. First, I just wanted to thank the NHC, the Federal Home Loan Bank of San Francisco, and the Council of Federal Home Loan Banks for the opportunity to be here and speak a little bit about the AMA programs. I think Jeremy commented in his introductory comments that the Federal Home Loan Bank system is arguably the least well-known institution relative to its size, scale, and reach. And that's a comment and a sentiment I certainly agree with. And I'd say, multiply that times 100 when it pertains to the bank's mortgage purchase programs. There's a lot that we've done in this space over the 25 plus years that they've been in existence. And the reality is they've been very under the radar, and the awareness of, I think, what we do has been relatively limited. I'm not suggesting that's always a bad thing. I think it's enabled us to do a lot of good things, operate through the financial crisis with continued freedom relative to some of our peers and competitors in this space. But I think it's really a time where we can acknowledge the roles of the mortgage purchase programs and talk about, I think, the most important topic: what can we do that would be a bit more impactful? So during these remarks, I have about 10 minutes, and I'm planning to cover 3 general topics. One, in the vein of awareness, just provide a bit of an overview for the Federal Home Loan Bank's mortgage purchase programs, the AMA programs. What do they mean? What do we do? Highlight a little bit about the current state of the programs in connection with the current state of the industry. And then I really want, I think, the primary takeaway to be to express our desire, my desire running the MPF program and the desire of many of my colleagues that participate in their role running the mortgage purchase program at the banks, to be a true partner with a seat at the table going forward to address the affordability crisis that we face in this country, and to be a part of the solution that will require cooperation across industry participants. So first of all, just a brief overview in the vein of education and awareness. The AMA programs stand for Acquired Member Asset. They were formed in the late 90s based on, I think, some pretty innovative discussions and pushes across the Federal Home Loan Bank system to really focus on home loan in the name. And in addition to our traditional advances and AHP programs, provide liquidity to our depository lenders that participate in residential mortgage and actually acquire mortgage loans that we hold in balance sheet with a risk-sharing structure put around them. I think the value proposition at inception was really an acknowledgement that these community banks, credit unions, and generally smaller depository institutions originated extremely high quality and high performing mortgage loans. And that at the time, at least, they were disproportionately priced out, generally got worse pricing from a lot of the big industry players in favor of the economies of scale that some of the larger banks and IMBs were able to get. So recognizing that as the value proposition, this program was piloted in the late 90s and has been operating for the last 25 years. In MPF, the last panel, I think, touched on it. It's a good example of a long-term kind of shared service across the system. 6 of the Federal Home Loan Banks actively are using the program that we run out of Chicago today. Several of the home loan banks run their own program. But again, good example of an idea that was built and operationalized within one bank that several have been able to take advantage of for several decades now. In terms of the size and the scale, and the history, I think the program has been sufficiently battle tested, right? We've been through several events, several crises over the last 25 years that we've been operating, and the performance of the loans really speak for themselves. So I think that original idea and that mission about what we can do and the liquidity that we could provide to depositories that participate in this space has really, come to fruition. During the financial crisis, when some of the industry comps, Fannie Freddie delinquency rates peaked out at 6-7%, our program was barely above 1%. I think, again, really speaking to the role and the important role that depositories play in this space. Right now, the AMA programs across all the federal home loan banks have about $70 billion in outstanding UPB of mortgages. That's about 5 or 6% of the total federal home loan bank system balance sheets. Additionally, in the MPF program, we've operated as a Fannie Mae seller, as a Ginnie Mae issuer. There's about 25 billion additional volume there. So ultimately, that's about 100 billion in outstanding mortgages that run through our program right now. So what does that mean? About 1% of the market, right? Drop in the bucket. That's, I think, what a lot of people perceive our program as. But what I'm here to convey is that if you dig a little deeper and look under the hood and really acknowledge the state of residential mortgage origination and the extreme loss of market share across the depository lenders, we're much more than that. If you dig into our customer base, and this statistic shocks people, it shocked me when I came over from Fannie Mae and started working at the home loan bank system, we do business annually with about 1,000 sellers. When I was at Fannie Mae, we had about 1,100 active sellers. So 1% of the overall market, same reach in terms of actually reaching customers. Of course, these customers are smaller community banks, credit unions, folks that don't do or rely on a lot of mortgage production, but still want to be in the space to serve their customers and the communities that they operate in. And I think that's kind of the key value proposition and the key takeaway that many people do not realize, just the sheer reach and the scope that we have in this space. I personally, again, I acknowledge my bias, but I think it's been somewhat alarming that the market share for depository lenders in the residential space has gone from about 80% 15 years ago down to about 30%. So banks, depositories are opting to exit this space, dealing with kind of too much competition, too many hurdles, too many headwinds. With 25-30% of the market, I feel like now is the time, and many of my colleagues agree, that it's time for us to focus on our cooperative status, the value that we provide as a cooperative, and really think about things we can do differently that really we haven't evolved very much in the years following the financial crisis to help our members be successful in this space. Our core mission is really focused on providing liquidity, and I think historically we've really focused on our members and the liquidity that we can provide them. But transitioning a bit, I want to talk a little bit in the last few minutes about opportunities. I think in general, when we talk about affordable housing and the crisis that exists today, we've, with good reason, focused a lot on our AHP programs, right? Our grants, our down payment assistance, things that we can do to directly help in that space. But I think that there is a lot of really good momentum and a lot of really good tailwinds and kind of collective buy-in and agreement across industry participants that there's more that we can do with these mortgage purchase programs to partner in helping to drive success in this space. And I think there's a really good example during 2024 that we rolled out that, again, I think has been extremely successful, but I think very little awareness of. Several of the home loan banks that participate in mortgage purchase programs piloted this program called, it's a variety of flavors of names, but mortgage rate relief, permanent rate buy-down programs. I think 4 or 5 of the districts rolled it out in 2024 as a pilot and have basically dedicated voluntary funds from the home loan banks, kind of excess voluntary dollars committed towards AHP-like initiatives, and have offered a program that directly goes through the MPF program, the MPP programs, that offers consumers with a certain income relative to AMI, low, very low income borrowers, with 2 percentage points off of their mortgage rate, which the funds kicked in from the home loan banks guarantee that that seller gets a premium gain on sale on that loan. And the results have really been astounding. Just a couple statistics. During 2024, within the MPF program itself, there have been 130 sellers that delivered about 2,000 loans with an average note rate of 4.9%. The average borrower income for those loans was $59,000 or 54% of AMI. And the rate reduction that the home loan bank voluntary funds were able to provide resulted in about $2,500 per borrower of annual interest savings. That's about 5% reduction in DTI ratios. And that 5% reduction for the majority of these borrowers that took advantage of these programs enabled home ownership. Had an asset funded on the balance sheet of the home loan banks, got the borrower in the home. This is an example of a program that really, I think, based on an appetite to maybe be a little bit more under the radar, a little bit more kind of steady in the way the home loan banks have operated, just hasn't happened historically. I've heard a phrase that has kind of stuck with me over the years, that the mortgage industry moves slowly and with good reason. I think we've seen that that risk has emerged, but I think given the current state of the affordability crisis and the challenges that lenders and borrowers face, it's really time for us to kind of shake some of that sentiment about staying under the radar and kind of sticking to our knitting and thinking about ways we can do more. So looking ahead, I just conclude by saying that the core mission of our mortgage purchase programs, I think, will persist. Reliable provider of liquidity across all markets for lenders that participate in this space. But if I was to leave this group with one thing, it's just that there is a real and genuine appetite and opportunity for these mortgage purchase programs to be a lot more involved in the complex solutions to this crisis. So I very much appreciate the opportunity to be here. I hope that the AMA programs and the mortgage purchase programs offered by the banks can be more of a regular dialogue as we think about creative solutioning necessary going forward. And I very much look forward to working with all of you as we continue down this path. So thank you.
Well, thank you, Patrick. That was great. And I'd now like to invite our next panel to the stage, A Century of Impact, Examining the Federal Home Loan Bank System's Legacy and Future, which I have the pleasure of moderating. Okay. So welcome, everyone. I'll do some brief introductions, and then we can get right into it. I also want to just note that we've had over 200 people online today, so appreciate our online participants and anticipate that a few of you may have intended being here, but we're spooked by the weather, and I just want to say that you missed a really great lunch. So we did not save you in.
Well, and we appreciate the folks that did brave the weather.
We very appreciate the folks that brave the weather because, of course, there is no weather, it's just drizzling out. Welcome to Washington.
Yeah.
So Ryan Donovan, on my left here, is President and CEO of the Council of Federal Home Loan Banks, a role that he's held since September of 2022. A seasoned public policy advocate and trade association executive, Ryan has spent his career shaping financial services policy with experience both on Capitol Hill, working for former House Democratic leader Richard Gephardt, and Representative Brad Sherman, and in the advocacy arena. Prior to leading the council, Ryan served as Chief Advocacy Officer at the National Credit Union National Association, CUNA, where he held the credit union system's advocacy strategy for 15 years. Bart Zivi?
Zivi, yes.
Zivi, thank you, is a lawyer with more than 40 years' experience working on financial institution issues in general and Federal Home Loan Bank matters in particular. He has worked on policy formation, both the inside and the outside of government, and Bart was the principal draftsman for the U.S. Senate Banking Committee for changes in the Federal Home Loan Bank Act that were enacted in 1989. During the 1990s, he served as a strategic advisor to the Federal Home Loan Banks, helping them obtain the legislative reforms to the Federal Home Loan Bank Act adopted in 1999. And since 1987, he has been in private practice at his own law firm, which is located in Sausalito, California. Jim Hilton has over 30 years of experience in the financial services industry. He's currently a partner at Ludwig Advisors, where his work has consistently helped financial institutions develop and implement strategic initiatives in an increasingly complex regulatory environment. That's an understatement. Could get a lot simpler soon. We're going to put a lot of lawyers out of business.
Simplicity can be complex.
It certainly can be. His career began in the legal department at the Federal Reserve Bank of New York, followed by a focus on transforming trading in the capital market space as both the head of strategic planning and product management for the Prebon Group and as general counsel for the Chicago Board Brokerage. And finally, my friend Jim Tobin is president and CEO of the National Association of Home Builders, has more than 20 years of association experience and a diverse housing policy background. He was congressional representative for the Western United States with policy expertise in the environmental and tax policy arenas, and most recently, Jim served as the association's executive vice president and chief lobbyist, where he's responsible for directing the federal, state, and local lobbying as well as political activities for NAHB. So let's get into this. I think that we can start with some of the misconceptions we have about the Federal Home Loan Banks, which is going to be useful in talking about the future and where we go from here. So let me start with Ryan and Bart. Ryan, tell me about some of the common misconceptions of the Federal Home Loan Banks and how that kind of makes itself apparent in the discourse.
Yeah, so I think just to begin, I'd point out two. The first is that we are, well, the conception that they should have is we're member-owned financial cooperatives, because we are, right? The misconception is that we're somehow a function of the government, an extension of the government. I think that has a lot to do with the GSE moniker and frankly, our name, right? Federal is right there in the name. But the S in GSE doesn't stand for supported, it doesn't stand for subsidized, it stands for sponsored. If you look across a number of industries, there are a whole host of government-sponsored enterprises, entities that have had either a charter created by Congress or are subject to some sort of regulation that provides their power, restrictions, and their mission. And so, there's no denying that we're a creature of Congress, but I think one of the most common misperceptions is the ownership structure and, by extension, the value proposition. The Federal Home Loan Banks are member-owned financial cooperatives, and so for us to be successful, it begins with providing the members value to their membership.
Bart?
So I'd say that, the stack of tasks that the home loan banks undertake is not well understood. So they definitely have a housing component. That's the AMA, and long-term advances are directly tied to providing housing finance in the regular market, not subsidized. Short-term advances, however, can be used for any purpose by the members, and there has been a historic connection between using those advances in economic crises and providing loans to members who were in extreme, dire circumstances. And every time one of these crises comes up, and I've been through 3 of them in my career, the home loan banks take a lot of flack because people are sort of unable to distinguish between the fireman and the arsonist, right? They both appear in temporal proximity to the fire, but one's sort of the good guy and one's sort of not. And the home loan banks always get swept up in this sort of brouhaha, and we heard of a bit of it today with, Silicon Valley Bank. And, it's very easy to caricature Silicon Valley Bank as these tech bros run wild with home loan bank money. But go look at the 10K. They had over $90 billion in hold-to-maturity assets, over $20 billion in available for sale assets, and the vast bulk of that stuff was agency mortgage-backed securities, financing for middle-class families. And the big problem they had was they funded those with overnight uninsured deposits. Now, doing that in a regular interest rate environment is playing Russian roulette with one bullet in the chamber. Doing it in the interest rate environment where the Federal Reserve has pumped $2.8 trillion into buying MBS and completely artificially inflating the prices of MBS so that, for macroeconomic purposes, that's putting 6 bullets in the chamber, right? You're going to die, and it's just a question of when you pull the trigger. So
Probably doesn't help that they didn't have a chief risk officer.
yeah. So the flack that the home loan banks get for helping troubled institutions is very ironic, because then they always say, you need to go back to the Garden of Eden when the home loan banks were formed during the Great Depression, because then they were just helping middle-class Americans buy homes. And that, of course, is also a bunch of hooey. The original 2,086 members of the home loan banks were these institutions called building and loans. And probably the only one you've ever heard of is Bailey Brothers Building and Loans in It's a Wonderful Life. They were financial basket cases. The general counsel of the Federal Home Loan Bank Board testified on May 17, 1934, in front of the Senate Banking Committee, and he presented the average balance sheet, the assets of the ones who had made it in, these 2,086 out of the 11,000 building and loans. They had 9.9% of their assets in REO, foreclosed homes. They had 22% of their assets in seriously delinquent loans, and by that it was either 6 months up to 3 or 4 years. The rest of their assets were these interest-only, with no maturity date, loans, where probably, half of them were negative equity because home prices had declined 30% from 1929 to 1932. So if that's the Garden of Eden, count me out, right? It's like that's not where the home loan bank system should go. And today, it's not, right? You have a much more diverse system of membership. It's not just one little club, and they're no longer just taking treasury money invested into the stock of the bank, their original funding, and handing it out so that these building and loans could pay off their depositors. They didn't do any lending in the first 2 years of operations. In fact, for most of them, it would have been illegal to lend money to buy a home, because they had a provision in their state law that said you have to pay off depositor demands before you can make any loans. And the general counsel testified that at least 50% in 1934 were unable to meet the depositor's demand. So you'd walk in and say, "Can I have $10?" And they go, "Come back next month." So that's the origin story of the home loan bank, not this fantasy tale that's been concocted.
I just want to say that George Bailey was not a basket case. Uncle Billy, I'm going to reserve judgment on. And if you haven't seen that movie, you really need to watch it. So let's talk about, one of the things that I find interesting is we have 1989 legislation that definitely came in the midst of a basket case. You've got the 1999 legislation, and that made changes that shaped the system. But conspicuously absent is the 2009 legislation, which you did not need. And I think that's one of the interesting things, is that, Federal Home Loan Bank system may be one of the few institutions through 2008 and 9 that didn't need a bailout. So can we talk a little bit about that and how we navigated through that period in particular, because I think that also is an indication of how some of the risk management and the way the banks are structured that makes a difference in pretty severe economic conditions.
Right. So 1989 was when the system opened its doors to commercial banks and credit unions. And so that, to people who follow this a little bit, that sort of always gets picked up. But what they don't talk about are the severe restrictions on those commercial banks and credit unions for borrowing from a home loan bank. So first of all, they had an overall 30% cap on all borrowing by banks and credit unions. There were differential stock purchase requirements, so they had to buy much more stock. And then a key point was there was a provision that said commercial banks and credit unions who didn't have a mega percentage of their assets, over 60%, in housing, could only borrow money for housing, right? And so in 1992, for example, you had like 25% of the membership was commercial banks and credit unions, but they only composed 5% of the borrowing because of all these restrictions that made it unattractive. And what happened in 1999 was Congress had 10 years to sort of look at the flow. They had seen how commercial banks were limited in their borrowing, and they removed those restrictions. They removed the 30% limit. They equalized the stock purchase requirements. And more importantly, for sort of the common discussion today, is they allowed these commercial banks and credit unions to borrow for any reasonable business purpose. And that basically transformed the system. That was the key switch. And if you, there are some materials I have that are probably available online here that shows the transformation of the system. It had roughly 500 and some billion in advances and grew to 2023 to 1.2 trillion. But the AHP went from under 200 million in 1999 to over 900 million in 2023 because you had advances and retained earnings growing, and the retained earnings allowed additional investment income to be made. And so for the people who say, you know, let's only limit the bank system to the true believers, 1999 says, you know, that's not exactly the prescription. If you want to really grow AHP, let everybody in and then convince them over time to be true believers. And meanwhile, make a boatload more money and send a boatload more money into the AHP.
Well, and this is the concept of cross-subsidization, which I think is often one of the most important elements and one of the most easily dismissed until it actually happens and you don't have it. Ryan, tell me a little bit about the report that came out, FHFA System at 100 review, and what are the specific changes that this is driven, and also with the change in administration, how are we looking at that report today?
Sure. Well, it's a big question. And I'll tell you, when I started in September 2022, FHFA had announced the review process within a week of me starting, right? This was, a big lesson for me, and make sure you ask the right questions during recruitment process. But I think that the impact of this process is more than the report, right? So for the home loan bank system, we listened throughout the whole process. The agency, I think, it should be commended on the fact that they had a very comprehensive listening process. 3 days of listening sessions, more than a dozen regional and virtual roundtables, 2 comment periods, concluding set of listening sessions. They heard from 1,000 people. About 80% of them were very supportive of the system. And whether you were supportive of the system or you weren't supportive of the system in that process, the overwhelming theme that the agency heard was that folks want more from the home loan bank system and not less. And I have a very distinct privilege of being in a lot of conversations with leaders of this system. And throughout the process, I saw a lot of development and change in the system. I think it brought us closer to home loan bank members and to stakeholders in local, regional, and national communities. I saw a change in how the banks look at their CDFI members, and some of that was reflected in work we did, or we tried to do last year with the Department of Treasury, where we said, listen, we hear the CDFI community, and we understand some of the impediments that keep them from having as equitable access as other members have a lot to do with the regulations that are in place and the perspective that the agency had, the finance agency has on their risk profile. Joe Neary's name was invoked earlier in the day, and he and I had a number of conversations last year where we said, let's figure out where is there common ground and how can we advance that. So even before the report was issued, the Home Loan Bank system was busy working to respond to what we were hearing. And some of the tangible components of that response were a commitment on the part of each of the 11 banks to contribute more than what is required by statute to affordable housing. The number that the banks landed on was 15%. That's 50% more than what's required by law. And as a result of that commitment, when we report our combined financial report next month, I expect that the contribution level or the commitment level will be north of $1 billion last year. Now, we were already the largest single source of private capital support for affordable housing in the United States. But last year we will have committed, I think, over $1 billion. That's incredible. Now, we can talk about like the recommendation in the report to reform or modernize the HP application process, which we supported. That was, that's a rulemaking that I hope will continue in the current administration. But I think there's an argument to be made that the agency, and we made it in our letter, that the agency needs to go further in reforming AHP. And there were a number of ideas that were put forth on various usages of those funds. It may be prudent to explore that. I'm not taking a position on any of that, but it's prudent to have the conversation about how you can make those dollars more impactful. So, the message that I want to deliver is that during that process, we listened, we began to respond. There's certainly more work to be done. There's no question about that. But I think that the report and the process really helped strengthen the system. Now, to your question, and I'll pause to let others talk, but to your question about the next administration, I think that, or the current administration, I think that we see an opportunity with the new administration to reset a relationship with our regulator that was surprising to me, but it's a very complicated relationship. It's often, I think, a very one-sided relationship, and I don't think it always helps us advance our mission the way that it is. And so maybe we can get into some of those areas later, but when I think about how will we interact with this new administration, I see opportunity to reset that so that we can continue to fulfill our mission.
So, and we will for sure. Let me go to Jim Hilton and talk about one of my favorite subjects, which is that the law of unintended consequences is never repealed. Tell me a little bit about some of the unintended consequences that came out of the report, and that also that you're concerned about as we move forward into this new era.
I want to pick up on some of the things Bart said when we talk about the rule of unintended consequences. We talked about the home loan banks serving as a lender to distressed institutions. I think it's critical to say that, agreeing with everything Bart said, we overlook what an important lender the home loan banks are to non-stressed institutions in times of stress. If we look at the time around SVB in First Republic, going back, certainly we saw, and I'll talk in a minute about the advances to those institutions and some of the unintended consequences around there. But what we also see are massive advances going out to otherwise stable commercial banks, right? The Federal Reserve, the discount window, and the discount window was my client once upon a time, and I think very highly of what they do, and dedicated professionals. They are, probably a lender of last resort. They are not a lender of penultimate resort, and they will say that. The home loan banks have stepped into that role, and whether that was an unintended consequence of the legislation or not, it's critical to the way the financial system is structured at this point. We don't like to say it, but too big to fail by the numbers seems to be a real concept. In times of stress, we do see deposits moving to the very, very largest institutions, maybe not on the consumer level, but on the business level. And that leaves our large, but not largest, and our small institutions at a loss, without funding, without secure funding in the near term, and without the home loan banks stepping in, you'd see a huge constraint in lending, because there wouldn't be a good, reliable source of liquidity for those institutions. Where do we see the unintended consequences? We saw an awful lot of noise around SVB about prepayment penalties. And the FDIC thinking about the hit to the insurance fund that came first when it had to repay in advance, and second when it had to pay a prepayment penalty to the San Francisco Home Loan Bank to pay back the advances that SVB had made in the weeks and even days leading up to its failure. I think a couple of really important points to point out, to take away from that, and somebody mentioned it earlier in one of the panels today. One of the things that the home loan banks have done very well is step in and be the capital market intermediary for our small and intermediate sized institutions. And what that means is, unlike us individuals who get mortgages, we don't realize it, valuable embedded options in our mortgages, right? If interest rates goes down, we get to repay without penalty and refinance at a very low rate. If they go up, as they've gone up now, we sit in our mortgages and we stay in our houses and we freeze up the housing market, right? The capital markets don't work that way. If you take out a 30-year advance and agree to pay 8% for it, you're going to do that, even if you decide, either 6 months later or 1 week later that you'd much rather pay it off. There's a real cost to the system for repaying that advance, and that's a cost that's passed on to borrowers. It's worth pointing out that by FDIC regulation, right, they're actually not paying the cost that SVB agreed to pay. They're limited to paying pure economic losses. They're not allowed to pay a prepayment fee from the insurance fund unless it's tied to a real loss. So there is protection, but there's negative press that comes with these things, and it's very hard to get around. The other thing is, I think Bart had said, what did you say? Tech bros running around playing with somebody else's money, something like that, some characterization of what happened at SVB. And the FDIC had to come in and bail it out with its money. First, I think it's worth pointing out everything that Bart said about the assets that were there. Second, it's not clear that there will be major losses ultimately coming out of SVB. They were subject to a classic liquidity crunch and a run on the bank that accelerated in a way that we haven't seen before, but we certainly will see again, right? Runs on banks aren't going to happen over months and weeks anymore. These were happening over hours, and in the end, literally minutes. We could see the funds leaving the bank. And people are going to need to be ready for that. And don't know if any of my friends from the FDIC are here, but we have issues with the way we resolve banks. The FDIC is, I'm sure, more than capable of stepping into a bank at any time of day, any day of the week, but is much more comfortable stepping into banks late Friday afternoon and reopening Monday morning. That wasn't going to be an option at SVB unless there was more funding there. Both the Federal Reserve and the FDIC had the option of telling the home loan bank not to advance funds, right? To come in and say, this bank isn't solvent, isn't worth saving, please don't put any money, and there was nothing, right? Nothing came out. So there's a service there. So unintended consequences, we have to be careful of limiting that authority so that people are able to step into a crisis. I'll pass on one story which I'm afraid will be prescient, not directly related to the home loan banks. Again, I won't use a name, but I started my career at the Federal Reserve Bank in New York. And if you're a lawyer for a central bank like that, one of the things you regret is not being there for the real financial crisis, because that's a time of real growth and real excitement and hopefully doing real good. And I talked to one of my very good friends who did live through that crisis. and it talked about the work that he did. And he said, it was great. We feel like we did a good job. In fact, he said, I feel like we saved the world. He says, but unfortunately, I'm going to spend the rest of my career not doing it, but testifying about it. And we'll have that authority taken away, and we'll never get to do it again. That's a real concern. Ultimately, our financial system needs people who can step into situations that aren't completely predicted to provide liquidity where it's needed and help smooth out very big bumps in the road. We have to be careful about taking that power away from people who can wield it wisely. We want people who can wield it wisely, but it needs to exist. So let me stop.
No, thank you. I think that's really helpful, and I think what we've done is established kind of the foundation of the big question, which is how do we look towards the future? Yeah. And in that case, I'll go to Jim Tobin, because really housing production and supply is at the heart of our affordability crisis right now. That goes back to the Great Recession and the impact of the mortgage crisis on home builders. You've been slowly building that back, but we still have capacity issues, and we still have capital and funding issues. Tell me a little bit about how the Federal Home Loan Banks play into that, and more importantly, what do builders need now from their banks and from institutions like the Federal Home Loan Banks?
Thanks, David. I'd like to say housing production is enjoying a moment for the first time in probably anyone's career in here. We've been talking about housing affordability for 20 years, 30 years, 40 years, but this is the first time that any of us can remember where the actual solution to it is actually to build more housing. And so what we need is a system that's actually going to lead the way in helping us to do that. And our members will build 80% of the housing in this country over the next year. The problem is we're not building enough of it fast enough. As David just said, since the Great Recession for the last 15 years or so, we have underbuilt in this country for a variety of reasons. Many of it was economic, many of it was just the builders don't want to get as extended as they did in 2006 for obvious reasons of what happened in 2008, and much more cautious. And so we've dug ourselves a pretty big hole, and until we even just meet regular demand, we have to build about 1.5 million single and multifamily units a year just to keep up with household formation, replacing the existing housing stock and immigration. Never mind digging ourselves out of the hole of that 1.5 or 2 million units that we're behind. And so what we need right now is a system that's going to find ways to bring that liquidity to homeowners. Obviously, we're in a high interest rate environment. That's going to continue to keep demand down. But when I think of the other side of the mission of the Federal Home Loan Bank system of community development, I think of jobs. And if we're going to create economic opportunity, which means more jobs, those people have to go somewhere at night. And they've got to have an affordable apartment or an affordable home to be able to go home to. And we've got to find ways for the home loan bank system to not only keep the mortgage markets going, but the lifeblood of our industry is acquisition, development, and construction lending. And that is primarily done by the small banks in this country, the smaller banks and community banks in this country, which are the ones very much supported by the home loan bank system. So I'd like to see a system where we can find a way to get a securitization or a churn in AD&C lending that helps our members get lower cost loans than they can get now. So we can take more risk and we can build more housing and more housing affordably. As I earlier, somebody said attainably, because attainability and affordability is different for every one of us in this room. But if we're going to truly meet the crisis ahead of us, and build more housing, the home loan bank system is going to be key to that. And we need to make sure that it stays vibrant, well-regulated, but more importantly, allowed to innovate and allowed to really stretch out a little bit. That's what I think.
Well, we have a unique scenario right now where the nominee to run the regulator for the Federal Home Loan Banks, as well as Fannie Mae and Freddie Mac, comes from a renowned home building family and is an investor himself in new construction and homes. What should we expect and want from the new administration at FHFA? And what's our ask list?
How about not tariffs, Did I say that out loud? Sorry.
I'm happy to talk about tariff
Yeah.
integration,
Well,
but
yeah, no, that's a completely different panel.
it is indeed.
No, many of us have talked to the nominee, Bill Pulte, and he's made a commitment to the supply question. I mean, and the president has said as much, right? That he said we want to build more housing, and we want to make sure that we're providing the mechanism to finance that. That's music to my ears.
Yeah.
And I imagine everyone's ears here as well. But the question is, how are they going to do it? Obviously, there's the specter of recap and release when it comes to Fannie and Freddie. So I think that's going to dominate the headlines. But we have to make sure the home loan bank system is not caught up in some kind of collateral, whether it's either on the Hill in the regulatory environment. But I'm excited to work with this administration. Like I said, there's a lot of headwinds facing the building side of the equation, and maybe some unforced errors in the future. But the liquidity side of this and the financing side needs to be as much a part of it as some of the other headwinds we face.
Right.
Could I just add one thing here? This isn't the biggest proposal in the world, but I think it would help strengthen the connection between the home building community and the home loan banks if FHFA would once again allow home builders to be on the boards of the home loan banks. It's something that I know the home builders have asked for in their comment letter on the governance rule, and so did the home loan bank system.
And why isn't that the case?
For many years it was, and I think it was a different priority of FHFA over the years to favor different types of expertise on the boards. Jim, you may have more background on that.
Yeah, I think that's right. I think we had many members serve on bank boards across the system for decades, and that has wound down. In fact, we're down to not many more than one or two, I'm afraid, across the system. And so when I think about the expertise that needs to be on the bank boards, if we are going to really truly delve into the problem of affordability, attainability, and building more housing to overcome that, then you would need that diversity of experience on those bank boards of the people who are actually building the housing in this country. And I think it's a very unique perspective. And that is something that I think that the boards are missing right now. And it's critical that as we work with FHFA to try to expand that list of experience and expertise that's allowed to serve on the bank boards, and hopefully get more builders who know their communities, know what it takes to build housing affordably onto those bank boards. So thank you for bringing that. I appreciate that.
So let me ask this now, while we're on the subject of FHFA leadership. I want to go down the line and ask you all, in the next year, what would you say should be the top priority in terms of initiatives for Bill Pulte, if he's confirmed, to take, both in terms of, one, what's the low-hanging fruit, the opportunity for a quick win that makes perfect sense, and what's the more aspirational goal that you think really needs to begin to evolve? So, Ryan, why don't you?
Oh, thanks. I'm going to keep it home loan bank specific because I know the agency's got
We'll set aside Fannie and Freddie
yeah.
and all of that, which may take a little bit of his time.
I think that the low-hanging fruit would be the work that's been done on AHP, right? Mm-hmm. That's there's been a lot of work done. They should evaluate the comments that were made and put together, carry that forward. More aspirational, there is a tremendous amount of oversight and overregulation that the banks are subject to. There is a policymaking process that I often describe as Alice in Wonderland here, where the agency has a tendency to go bank by bank and make a finding and make the same finding at the next bank and finding very similar at the third bank, and then before you know it, they put out an advisory bulletin to the banks, and the banks respond to that and comply with that, and then maybe someday there's a rulemaking that comes out that's finally available for everybody to put a comment in on. If you're changing the expectations for all 11 of the banks. That's not a supervisory move, that's a policy change. And there is a procedure for doing that under the Administrative Procedures Act. So it shouldn't be aspirational, but one of the aspirations that I would hope the new administration would follow through on is let's do rulemaking the way that rulemaking is done, through the Administrative Procedures Act, instead of going bank by bank and exerting the changes that way.
Okay.
Let me start with a comment on that, if I could, rather than come up with something original, because it's more fun. That would be great for the home loan banks, but what you said mirrors the wish of every commercial bank out there, right? The FHFA is not acting any different than any of the other banking regulators at this point. This is the wish of every bank that we deal with. So maybe this is a way of agreeing with you, and maybe just stressing how aspirational that is.
Yeah, no.
Or what a big mindset change it is in the way that banks generally, including the home loan banks, are regulated at this point.
And, I just want to say that, we're certainly in a phase early in the administration where the wrecking ball is the principal tool that's being used. And I have to say, rather than send everybody in a regulatory agency home or fire them all, actually taking the time to reform and consider how the rules work and don't work, is where you're going to have lasting change, because otherwise we're going to end up with a pendulum swinging back and forth, and all they've basically done is to set up a scenario where it's the other guys who rewrite all the rules. And I think what we really want is to find the middle of that pendulum somehow and stop it swinging so fast.
Well, and when you do that, it will do what I think is the most important thing that the finance agency could do, over the next several years, is it will restore confidence in the home loan bank system. Mm-hmm. Right? There was a credit advisory bulletin that, a credit risk advisory bulletin that was put out last year, and in the months leading up to that, we had members who would hear from their examiners, whether it was OCC, FDIC, the Fed. I'm not familiar that NCUA was doing this, but it could have been NCUA too, who were saying, how reliable is the home loan bank, and how are you, what are you considering in terms of your ability to get liquidity if you need it, if you were downgraded. And a lot of that was just driven by rhetoric that was coming out of the finance agency that ultimately resulted in them issuing a credit risk advisory bulletin last year that no one had seen before it came out. I asked Director Thompson directly, will you put this out for comment? Because we were hearing concerns from the community banks and from ABA and others. There's a lot of work that I think needs to be done by the finance agency, and we're willing to work with them on this to try to restore that confidence that, in the eyes of our members, but also our members' regulators.
I want to come to what you said about rules, and this would be, to the extent I offer any advice to the administration, to correct what seems to be what I think of as a misperception on deregulation or making things easier for the regulated. And coming in with a wrecking ball and just ripping up the rules actually is going to make things worse for most regulated entities. What most institutions are looking for is some certainty in this regulating activity through supervision through an informal process is much more the enemy than here's the rule, you need to follow it. We may not like it, it may be unduly restricted, but I can plan around that. What really hurts is I don't know what you're going to think about this. I don't know how you're going to react to what I'm doing. And maybe you're not going to say the same thing to the bank down the street or in the next district, because it's varying examiner by examiner. So that certainty is almost, we want good regulation, but at least we want, in the absence of good, we want it certain, right?
Yes.
Yeah, I think that's came up over and over again in the whole CRA reform initiative, going back to Secretary Mnuchin and the original memorandum to regulators, and then this really unfortunate process of the pendulum swinging back and forth in a way that was not sustainable for either rule.
Yeah.
And the idea that clarity comes up over and over again. Give us clarity, and we can lean into what you want and better serve the people you want us to serve. So, Jim, Tobin, let me come to you and say, if you were FHFA director for a day, how would you? What would you say? This is what you really need to do to help home builders.
I really think it's creating a secondary market for AD&C lending. We've approached them for every director for 10 years now or 15 years now, asking that same question. It's not as easy as we think, obviously, but that's
well,
the
we
magic
actually
one.
talking to a guy who had to get an AD&C loan.
Yeah, right. Yeah, there you go. Right. Yeah, that's the magic wand. I think realistically, I think it'd be great if all the housing folks are talking regularly, whether it's HUD, Treasury, FHA, and talking about kind of that whole of government approach to how do we build more housing. And while you don't want to start stretching into environmental regulations, things like that, I think there is a role for FHFA to play and say, look, if we're going to do this, here's our sliver, but we see all these other pieces that are complicating this, and can we all get on the same page and try to kind of row in the same direction?
So the one thing that I would put at the very top of my wish list is actually an old favorite. It was something that was done at the tail end of the George W. Bush administration in 2008 because of the great financial crisis, right? So mortgage lending had seized up, gotten more expensive, and so they temporarily lifted the limit on home loan bank investments in agency mortgage-backed securities. It's set at 3 times capital, and they lifted it to 6 times capital. And I think, given the overhang, I think the Federal Reserve is still got $2.2 trillion in MBS on its books that it's winding down, and I think that's putting pressure on the spreads. You see the MBS spread at an abnormal high over 10-year treasuries. And the home loan banks don't have the firepower of the Fed, but it's sort of every little bit helps kind of thing. And, someone was talking about voluntary programs. You could make this a voluntary program and say, you've got to kick a little extra juice into the AHP from this additional. Maybe you can address the risk of going from 3 to 6 by saying and put some more into the restricted retained earnings account that the home loan banks have. And just to sort of comment about the investment and dividend dynamic, because that was raised at a panel. To put it simply, the home loan banks as a cooperative are not an investment vehicle. So the dividend is like a cash back item on your credit card, right? So it's the borrowing by the members that generates the income, and the dividend is just a rebate. And the question is, how big is that rebate going to be? And that lowers the cost of funding. It lowers the advance rate in a all-in method, and allows institutions, to borrow at a better rate than they could and go out into the economy and then lend money at a spread at that lower rate. So I think that would be my number one wish list.
So let me bring up non-banks, because non-banks, mortgage companies that aren't banks, make up a significant majority of mortgage loan originations. And they also have unique liquidity constraints, as we recently found. And it did not end up being a crisis, but it was scary as the interest rates rose very rapidly. Can the federal home loan banks play a role in addressing non-bank liquidity without legislation? And if we need legislation, what should that look like? Or is the juice worth the squeeze, so to speak?
No, it's a good question, Dave. I think that home loan banks do play a role. They play it through their members, through the warehouse lenders that serve the non-bank mortgage lenders. And any change in that regard, with whether it's non-bank mortgage lenders or any other entity that might be interested in membership in the Home Loan Bank, that has to be done by Congress. And one of the things that the banks and credit unions, insurance companies, certainly have in common is the fact that they're regulated. And I think that's an important component when you consider what type of entities are eligible for membership in the Home Loan Bank system. And with the CDFIs, we see the consequence of having a membership class that is not regulated in the same way as insurance companies, banks, and credit unions are, and the challenges that they face in getting equitable treatment. But ultimately, it's a matter for Congress to decide. And to your original question, we're serving them now through our members.
Jim?
Answer the question just a little bit differently and think about what can the home loan banks do to get the community banks to compete better with these non-bank banks. Mortgage lending is, right, underwriting is, whether we like the standards or not, relatively straightforward. Operationalizing that is incredibly complex. And if you're a smaller institution, running a mortgage book is just not something you're likely to do. And if there's a way to either decrease that burden or socialize that burden in a cooperative way, that may increase the total amount of lending and have the community banks participate in a way that they used to participate in this market with a higher percentage, but just aren't doing now.
Other thoughts on that?
There is one small avenue open, but the agency has sort of slammed the door on it, and that's the CDFI methodology, and the ability to form a de novo CDFI and join a federal home loan bank is practically impossible. There's like a 4-year period to get through the hoops to do this. So if you're a mortgage REIT and you have a chunk of your assets that would qualify for CDFI treatment, you could go to the Treasury Department, set up a subsidiary, and get that, blessing with the CDFI. But then you're sitting in the wilderness for a number of years, right? So they could take a look at lowering the barrier to entry for new CDFIs. And I know the sort of existing CDFIs would say, well, how does that help me? And I think the answer to that is you need more people in the boat, because your big problem is the collateral mark. The collateral mark is based on the differential between bankruptcy law and receivership law. The credit unions face the same problem. They got the NCUA to change the rule in the early 90s. Insurance companies faced the same problem. They went state by state and got that equalized. The CDFIs, if there's only 24 borrowers, that's a pretty tough ask to try and get that legislation through Congress. But if you get a bigger boat and you get more heft, then, maybe you can have some traction on that issue.
So last thoughts on that, Jim? What should people take away from I understand that your 3 priorities are A, D, and C, A, D, and C, and A, D, and C. The 4th priority is, did you hear me when I said 1 through 3? Tell me about your 5th priority.
And the director thing too. Did I mention that? No, I think we have to. I would love to see, just kind of putting my old advocacy hat on for a quick minute. I would love to see the home loan bank system flex a little bit, right? I think in my career, I feel like the home loan banks have kind of stayed. If you put your head up, it could get chopped off. So you stay low and under the radar. I'd like to see you flex a little bit. You've got a great story to tell, and we should tell that, because you are part of the housing finance system. You all led off with what are the misconceptions, right? Well, let's blow those out of the water. I mean, there are a lot of, obviously, the housing industrial complex is large, and I think there's a lot of allies out there that can help not only tell the story but the successes of it, and flex a little bit on the Hill and in the regulatory environment. and tell the story of how you're part of the solution to build more of the housing that we want to build, and redevelop communities. And that's I think what I'd like everybody to take away with. It's just a really good success story, and shouldn't run away from it.
I think that's a great point, and certainly hats off to the San Francisco Federal Home Loan Bank and Ryan and the council for leaning into this. It made some people nervous, but as I like to say, you're either in the kitchen or on the menu, and I think it makes sense to be in the kitchen on this.
Yeah, and Jim, to your point, I think that's what we're trying to do here. Through forums like this, I just took the leadership of the system through a strategic planning process for our advocacy, how we're going to engage. What are our priorities? What are our red lines? What are the ways that we're going to engage policymakers so that we are telling an effective story that folks understand, so that we're not we're not thrown into a situation as we were 2 years ago where we're going to have this comprehensive review, but nobody knows about us. And as a result, the vacuum that we allowed to be created is filled by misconceptions or, folks that, are willfully ignorant of what we're doing. I think we'll be better positioned going forward, and we will be more actively engaged. And a big part of that is engaging with stakeholder groups, right? It's having conversations like these where we invite folks that don't agree with us to be a part of this conversation so we can hear their concerns, so we can have conversations with them. It didn't go unnoticed to me that at my table today, Sharon Corneliuson was sitting right next to me. And at lunch, Aaron Klein came in and sat with me. When we talk and engage, good things can happen. We may not always agree, but it's important to know where folks are coming from, to understand what their concerns are, what their interests are, and see where there is common ground. And I think we're gonna actively lean into that.
That's great.
I think we've really lost a lot of our historic ability to just listen to each other and talk with each other as opposed to each other.
Right.
And I think today is an important example that you actually can do that in Washington.
Yeah.
Who knew?
What a novel idea.
Jim, how about you? Last thoughts on this?
If what the banks are thinking about is getting their head above water and trumpeting, and you're looking for allies in addition to the housing mission, right? There were only 11 banks, and I don't know exactly how many states, whether it's 10 or 11. There's a community bank in every congressional district of the United States. They are wildly popular, right? People want to do things for them, and they agree on very little. I shouldn't say that. Sometimes they disagree on their priorities. They all left the home loan banks, right? They're all members. They're all borrowers. They all rely on the liquidity. Teaming with them, as I think about doing that, is it's nice to have allies where there are intersections.
Absolutely, and one of the things Aaron said to me at lunch, and I'm sure he wouldn't mind me repeating it, is he remarked on the strength of the Home Loan Bank System's lobby. Now, each of the banks has government relations folks, and they're great. The strength of our advocacy is our members. Whether it's we bring the community banks and credit unions together, right? But
not too often, I hope.
Well, but they share that common interest, right? They have they see the same value proposition in the system, and we're doing more with the insurance companies, and I think I hope that we have turned a corner or are turning a corner with the CDFIs, so that we're all interested in a stronger home loan bank system going forward and working together.
Well, that is really helpful. Let's give our panel a big hand. I thoroughly enjoyed this conversation. And I want to thank everyone for joining us for this important discussion on the future of the federal home loan banks and the vital role they play in keeping financial institutions and communities strong. Today's conversations have highlighted how their programs continue to drive real impact, expanding home ownership, strengthening workforce housing, and fostering economic growth. As we look ahead, the question remains, how do we maximize these efforts to meet the housing challenges of the 21st century? Collaboration, innovation, and a commitment to adaptation will be key. I also want to recognize the amazing work done by the entire National Housing Conference staff, led by Cara Bigay and Brittany Webb, Amanda Mitchell, Britt Van, Erica Ramirez, and Whitney Sarkody, and sincere appreciation for the leadership of Ann McCulloch and Jeremy Empel from the Federal Home Loan Bank of San Francisco, without whose hard work and generous support this event could not have happened. Thank you all very much. And thank you all again for joining us here and online, and we look forward to continuing this important conversation. Thanks for being here.